Okay, so welcome everyone to Financial Accounting 3A. So this is your third year module. It's a continuation of FAC 2. I'm hoping you can all see the introduction slides. Okay, so this is just to welcome everyone. We're so excited to meet you and well done on getting this far on your journey. For most of you, this is the last year in your diploma, and then hopefully you'll continue your studies or you'll enter the workforce. So FAC3, it's a continuation of FAC2. So you'll see some of the topics we are going more in depth, like the conceptual framework and also PPE, but there are also some new topics. Some new topics would be consolidations, intangible assets. So it's important that you go through the learner guide. The learner guide is on Moodle, and this is going to show you everything you need to know for the module, like when your practicals and your tutorials are. And it's also going to inform you of the assessment dates and how much each assessment counts, and your exam as well. Okay, so it gives you the exam date, which we already know, and it tells you how much the exam counts. So it's important that you check Moodle regularly, daily if possible, just to have a look at the announcements. And we often upload the tutorial and the practical questions, and then a week later we upload the solutions. And it's also important that you attend all your classes. So research shows that those students who attend classes and engage with the material are the most successful. Okay, so it's really important that you don't miss any sessions. And so lucky for you, the theory lecture is online. So if you want to recap, you can go through it again. But the practicals and the tutorials are in person on campus. Okay. So it's important that you attend those as well, because those obviously aren't recorded. So the opportunity, is a once-off opportunity. You must attend those and ask questions and engage with the material to be successful. This is the prescribed book. So this is the textbook. This should be the same book you used last year. And you should have access to it from last year as well. So it is the same textbook. These are the lecturers who will be taking you. So our first lecturer is Miss Slashwayo. She is going to be taking you for some sessions later in the semester. And if you want to consult with us during the consultation times, these are our offices. But please email just to make sure that we are in. We do have consultation times in the study guide. And then during those consultation times, whoever lectured you that week will be taking that consultation. But if you want to see us outside of the consultation times, then please just pop us an email and we'll see who is available on campus. Okay. Let's just see if everyone is in. Hopefully no one is in the waiting room. Okay. And the timetable, okay, so this is the timetable. We're just introducing the module for those that just joined. So you need to follow the timetable in the learner guide. Okay, so we haven't changed the times. So whatever times you see on your timetable, then you must go at those times. But sometimes we have to swap the sessions. So a tutorial, maybe a practical, just depending on the order. Okay, so that sounds confusing, but this is what you need to know, that our week runs from a Wednesday to a Tuesday. So this is the first day of financial accounting. We do the theory lecture on the Wednesday, and then the practicals on the same topic follow on the same week, Wednesday, Thursday, and Friday. Okay, so we have 3 sessions in the same week, the online theory class, the practicals, and the tutorials. And then we have what is called a tutorial practice session, and that will follow the week after. So, for example, today we are doing the conceptual framework. That is the online theory class. Then the practicals will start immediately after this class. So there's a practical later today, and then there's 3 practicals tomorrow, and then 1 practical on Friday, all on the conceptual framework. Okay, so the practicals follow in the same week as the online theory class. And then the tutorials start after the online theory class and run to next week, Tuesday. Then the tutorial practice sessions will run from next week, Wednesday, on conceptual framework. Sometimes in the tutorial practice sessions, we'll also have a look at zero accounting and maybe do past papers. Okay, so these are the groups. You should know what group you are in. We have group K, group L, group M, group N, and O. You should know what group you are in. And I want you just though to have a look at this. Whenever you see something on your timetable, go to that session, and then there should be a session. Okay. So let's just have a look at an example for group K. If you're in group K, then this is what your sessions look like. So the lecture, which is online today, which is every Wednesday at 8 o'clock, this is online. This is for every group. Okay, so we have one big theory class for all the groups. Then for group K, your practical session is on Friday at 9:40, and the venue is GNA B01. Then your tutorial is Monday at 2:40 in B5. And then your tutorial practice session will be the following week, Thursday at 9:40. And these are split into groups. Okay. So today, for example, we are having the lecture on conceptual framework. And then on Friday, Group K will have the practical, and then the tutorial on conceptual framework will follow on Monday. Okay. Then the tutorial practice session, that will be a week after. So that will be next week, Thursday, on conceptual framework. Okay. Simi, I see you have your hand up. Maybe you can just type your question in the chat. Like I said, we have a lecture today, so we can't spend too long on the introduction sessions, but I'll show you the module, the study guide just now to show you where your sessions are. Okay, so this is just an example of group K. Your group could be different, but everyone must be in the online theory lecture on a Wednesday. So notes will be loaded on Moodle before each class, so you can go through them in advance. I would encourage you to go through the sessions. You'll be required to access Moodle every week, so you must check for class announcements. We'll load additional study material as well as tutorial and test solutions. If you need to log onto the student portal, so please go to ULink. If you're having trouble, you can ask any assistants in the computer laboratory to help you. And we'll be using Moodle, which is the same learning system that we used last year. So these are your test dates. So test 1 is on the 12th of March. Test 2 is on the 22nd of April. And then if you are sick for either of those tests, there'll be a sick test on the 14th of May. And all of these tests will be on campus, and they are 1 hour and 30 minutes. Then the exam is on the 30th of May. And then the quizzes. So after each session is finished, so for example, when you have finished the sessions on conceptual framework, like the practicals and the tutorials, a quiz will open on Moodle, and you'll have a quiz for each topic, and then those quizzes collectively will count 10%. Okay. So just attempt all the quizzes. We usually do take the top 3 marks. So say, for example, you have 6 quizzes, and then we know maybe the internet may not have been good for one of them. So we usually take the top 3 of those 6. But I would encourage you to do them all. Don't just say that I'm going to do 3. because we haven't decided yet what counts. So just do all the quizzes, give yourself a good opportunity of doing well, and then we'll take the top three perhaps at the end of the semester. Okay, so look out for announcements on your test times and the venues for your tests. Okay. So your final assessment marks, so test one will count 20%, test two will count 20%, and then if you are sick, that will replace whichever test you missed. The sick test is not open to everyone, so don't rely on that. It is only for sick people, and we require like a doctor's note. Then your quizzes will count 10%, and then your exam will count 50%. But your exam is going to be based on all the material in the tests. So don't wait till the exam date to study. Do well in your tests so that you can do well in the year. Okay. So there's an emphasis on professionalism. So you guys are senior students, you're not new, so you know that you shouldn't be late. You should prepare for each class, have a look at the slides before you attend. This will help you get the maximum out of the lectures. You can also put your cell phones on silent when you have a session in person or even online. No talking whilst the lecturer is talking, or maybe your tutors, no talking while they are talking. Let's respect each other. So all the lecturers and tutors are very approachable people, and we are here because we want you to do well. Okay, so we are here to help you. Yeah, so let's just respect each other, and I'm sure we'll get on well. So these are the WhatsApp groups. Okay, so this introduction is on Moodle. So if you are in group K, you can join that WhatsApp group. Group L has a different WhatsApp group. So each group has a WhatsApp group. Please join the WhatsApp group that you are in, okay? So this will help you communicate with the tutors. And yeah, if there's any important announcements, often we ask the tutors to post it on the WhatsApp group. Okay. Um, and then, yeah, just welcome again. We are very excited to have you. Let's just have a look at some of the questions in the chat. So you do have practicals this week. So let me just go to the module outline and then, okay, so this is the module outline. Okay, so whatever group you are in, then this tells you when your sessions are. So if you're in group L, your theory lectures now, all the theory lectures are in one group. Your practical session for group L is on Thursday at 11:20. Your tutorial is on a Tuesday at 8. And then your tutorial practice sessions will be the week after on a Wednesday. Okay, so go to the study guide, which is on Moodle, determine which group you are in, and then see when your sessions are. Okay, so whenever you have a time on your timetable, match it to what is taking place here, and then you'll see what session it is. Okay, so it's important, you'll have to know what group you're in, or maybe you can match it based on when the sessions are appearing on your timetable versus the study guide. Okay, so we do have practicals this week. So group K has a practical on Friday, group L has a practical on Thursday, group M also has the practical on Thursday. Group N has their practical on Wednesday. Group O has their practical on Thursday. Okay, so that is this week. So attend your practical this week, and then have a look also at your tutorial times and your tutorial practice sessions. Okay, so we do have practicals this week. Sime is saying on the study guide, there's no group timetable that aligns with my U-Link timetable. Have a tutorial practical on Tuesday at 8 and a practical on the same day at 11:20. Okay, if it doesn't fit exactly, then you could probably just see which sessions you can attend. Okay. Okay, have a look at your tutorials as well. They'll also be starting after this lecture. Please join your tutorial WhatsApp group as well, just so you can keep in touch with your tutor. So they will also help you determine when your tutorial is. So just have a look at the WhatsApp group. So the WhatsApp group links are in this introduction slides on Moodle. So you can join your WhatsApp group as well. Okay. So someone is asking, is there a practical session after this class? Yes, there is. So there is if you are in the Wednesday practical, then that's the one you'll attend. You can have a look at the study guide to see which group you are in and when your practical is. There are practicals this week, Wednesday, Thursday, and Friday. So you must just see which group you are in and attend that practical. Okay. Okay, so the class you have on your timetable for face-to-face. Okay, so rather have a look at the study guide. That will determine which sessions are face-to-face and which are online. So every week, the online theory lecture will be online, and then all the other sessions are face-to-face. Your practicals are face-to-face, your tutorials are face-to-face, and your tutorial practicals are face-to-face. Okay. So whenever you see something on your timetable, you will have a session at that time. So sometimes we have to swap the sessions though to make sure they happen in the right order, like we want your tutorial after your practical. So have a look. This is the study guide, which is on Moodle. You have a look and whichever group you're in, have a look at these sessions, and this will tell you what is taking place. Where there is a venue, then that is obviously a face-to-face session where all the theory lectures are online every Wednesday. Okay. Okay, so guys, that is the introduction. We do have to start our lecture because that is why we are here. So this week we are doing the conceptual framework. Okay. You can just let me know. Can you see the slides for conceptual framework? Okay, just confirm if you can see the slides for conceptual framework. Okay. Let's start. Okay, so this week we're doing conceptual framework. For some of you, this may be a recap from last year, but you'll see we'll be going more in depth. Okay, so it's an important section. All the other topics build really on the conceptual framework. So let's have a look. So where is this in your textbook? So we are using chapter 2 of Gripping GARP. This is the same textbook that you used last year. So what are our learning outcomes? We are going to identify the purpose and objective of the conceptual framework. We are going to define and discuss the general purpose financial statements and their objective, like why do we have financial statements? We're going to apply the qualitative characteristics of useful financial information. We're going to define and discuss the elements of the financial statements. We're going to understand the objective of financial statements. We're going to understand the going concern assumption. We're going to define and discuss the recognition criteria of the elements of the financial statements. Then we're going to look at different measurement bases and determine the relevant measurement basis. And we're going to understand the concepts of presentation and disclosure. So that is everything we'll be covering in this week. So what is the conceptual framework? Okay, there's a new complete version of the conceptual framework, and it was issued in 2018. So the conceptual framework, it is a foundation upon which international financial reporting standards are built. So all the other standards we'll study, like the PPE standard and the intangible standards, they are all built on this conceptual framework. So it is the foundation for all other standards. The conceptual framework states the objective of general purpose financial reporting, like why do we have financial reporting? And the conceptual framework explains the various financial reporting concepts. Okay, so that is just some background. What is the purpose of the conceptual framework? So the conceptual framework helps the International Accounting Standards Board when developing the International Financial Reporting Standard. So it also assists preparers of the financial statements to develop accounting policies, and it helps users to understand and interpret financial statements. Okay, so one day you guys may assist in preparing the financial statements, and you will use the conceptual framework to help you with the accounting policies. And then users, maybe you'll buy shares one day in a company, and this you will look at financial statements and the conceptual framework to help you interpret these financial statements and decide like what is a good investment. So there are 8 concepts included in the framework. So we have the objective of general purpose financial reporting. We have general purpose financial statements. We have the qualitative characteristics of useful financial information. We have the elements of the financial statements. We have the recognition and derecognition area. We have measurement basis. We have presentation and disclosure, and then capital and capital maintenance. So you'll see that each of these is discussed in detail in the textbook, and we'll be touching on most of them in the lecture. So let's have a look at the objective of general purpose financial reporting. So what is the aim of general purpose financial reporting? So it's to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and creditors in making decisions relating to providing resources to the entity. So if you don't understand why you are preparing financial statements, or you don't understand the objective of financial reporting, it means you can't draw up quality financial statements. So the objective is here, we want to provide financial information about an entity that is useful to all of its users, which can be investors, lenders, and creditors, in making decisions relating to providing resources to the entity. So that is the objective. So then we have examples of resources that can be provided. So there can be equity and debt instruments, loans and credits, and then management actions. Okay, so these are resources that the entity can use Okay, then we have limitations of general purpose financial reporting. So there's limitations when we prepare financial statements and in financial reporting. So with financial statements, it only provides financial information, okay? Obviously, with integrated reporting, the integrated report is more concerned with non-financial information, but financial statements and the standards are generally concerned with financial information only. And the financial statements is not designed for all users, okay? It focuses mostly on like investors. That would be its main like user, but it's not it's not maybe useful to all users in the same way. It's not designed for all decisions. It doesn't provide exact information. So you'll see that some standards or some items in the financial statements are based on estimates. So it's not always going to be exact information. Sometimes estimates will have to be made if that is the information available at the time. Financial reporting also only provides historic information. So often there's a focus on what happened in the past, and it doesn't really include future information. So it is based on historical information, and the financial statements are not designed to show the entity's value. Okay, so these are the limitations of general purpose financial reporting. So it's good to be aware of these just when we think about the benefits. Okay, there's also limitations which we need to know about. So what is a financial statement? So a financial statement is a financial report that provides information about the elements. So remember, the elements are your assets, your liabilities, equity, income, and expenses. And remember that the different statements will include the different elements. Okay, so your statements of financial position will include your assets, liabilities, and equity, and your statement of profit or loss and other comprehensive income will include your income and expenses. So an objective of financial statements is to provide financial information about the reporting entity's assets, liabilities, equity, income, and expenses. So this is the objective of financial statements. So like we said, all the elements are going to be presented in the financial statements, and this is going to provide financial information to the various users. What is the structure of financial statements, or what different types of statements are there? So remember, we have the statement of financial position, and we said this shows your assets, equity, and liabilities. Then we have our statement of financial performance, which is also known as your statement of profit or loss and other comprehensive income. And this includes your income and expenses. And then other statements and notes that we have is the statement of changes in equity, which we'll have a look at this when we're doing groups. We also have a statement of cash flows, which shows the cash flows from the different activities. And then we have the notes to the financial statements. So every company will prepare all of these. If you look on the internet at a listed company, they will have all of these statements. So the statement of financial position contains information about the assets, liabilities, and equity that have been recognized. The statement of financial performance, this contains information about the income and expenses, and then other statements and notes. So this provides extra relevant information. So remember, we said the cash flow statement, we have the statement of changes in equity, and then the various accounting policy notes. So this provides extra relevant information in addition to the statement of financial position and the statement of financial performance. So what is the reporting entity? So this is the entity that is required to prepare financial statements. Some companies will choose to prepare the financial statements if they are not required to by like standards or laws. The reporting period, so this is the specific time period that they will report on. Usually it is 1 year, but it can be 6 months if it is interim reporting. This should be defined clearly in the financial statements. So when you are preparing your financial statement, so if we ask you to prepare the statement of financial position, you must say the reporting entity's name. We'll always give you the name of the company. So you must say it is ABC Limited. You will say ABC Limited, and then you'll say statement of financial position. As at, and then you'll put the date. Okay, so we always give you the name of the company and the date, and we would like to see that in your answer. Usually there's a mark involved. So it's important to know the company name you are preparing the financial statement for and the reporting period. The going concern assumption. So this assumes the entity will continue to operate for the foreseeable future. The entity does not intend to liquidate or cease operations. Okay, so for our purposes, we assume the entity is a going concern, that it will continue to operate and does not intend to liquidate. So now let's have a look at the fundamental characteristics, okay? So we have relevance and faithful presentation. So the fundamental characteristics, so what is relevance? This means that we are capable of making a difference, okay? So is something relevant, then it should be included in the financial statements. If it is relevant, we say it is capable of making a difference in the decisions made by users. And it also includes materiality. If something is material, omitting the information can reasonably influence decisions made by users. So everything that is relevant must be included in the financial statements. Then we also have faithful presentation. This is a depiction of substance over legal form. So information must be faithfully represented, and it must represent the substance and not the legal form. So the information needs to be complete, neutral, and free from error. Then we have enhancing characteristics. So the first two we'll look at here are comparability and verifiability. So what is comparability? This allows us to identify similarities and differences among items. So in order to compare something, you need at least two items. And you can be comparing for one entity this year to last year, or we could be comparing two entities. So say we have Spa and Pick and Pay, and we want to compare those entities, okay? So when the financial statements are prepared, they must be comparable, okay? It is a characteristic that a user will want so that they can compare from one year to another or from one entity to another entity. Then we also have verifiability. This assures users that the information has been independently assessed by knowledgeable observers, okay? So if something has been verified, if we know the financial statements have been verified, then this gives us confidence in the information provided, okay? We're not going to look at the financial statements and say, I wonder if they made a mistake here, because we know that the information would have been verified, okay, by hopefully an independent person. Then we have timeliness and understandability. So timeliness is very important. Information should be made available timeously so that users are able to use it in decision making, okay? So as soon as the year end is over and as soon as practical, we want the information to be made available. It must be timely. So if the information is given too late, then it's not going to be valuable, okay? So information should be made available timeously so that users can use it when making decisions. So the information should be available soon after year end, and the time issue should not affect faithful presentation. Okay, so there needs to be a balance of timeliness with faithful presentation. We don't want the information to be given to us 2 days after year end if it's going to contain like errors and mistakes. Okay, so there needs to be a balance between timely information, but it also needs to be faithfully represented and not contain like mistakes and everything. Then we have understandability. So information should be understandable to users. Information should be understandable. If it is not understandable, then it is not going to be useful to the users of the financial statements. So the information must be clear and concise. Okay, in order to be understandable, it must be given in a clear and concise manner. Okay, so then we have cost constraints, okay? So the cost of reporting financial information should be justified by the benefits of reporting that information. Differences in reporting may be appropriate because of the size of the entity, public versus private companies, users' needs, or any other relevant factor, okay? So whenever a company is going to prepare their financial statements or reports on their financial information, there's going to be a cost involved, okay? But that cost mustn't be more than the benefits that they are going to get by reporting that information, okay? And you'll see that when a big public company prepares their financial statements, this is going to cost more than when a private company prepares their financial statements, okay? Just because of the size of the transactions, the number of the transactions, and the size of the company, the cost will be different if it is a public company versus a private company. But in the same way, the benefits will be different. So a public company needs to report to their shareholders because it is a listed company and there are listing requirements or certain requirements that they need to comply with if they are a listed company. Then private companies will prepare financial statements, but they're generally not publicly available. So they're just preparing them for a smaller number of users. So we need to make sure that the cost of preparing the financial information does not outweigh the benefits. Then we have the elements of the financial statements, and I'm sure you guys are all familiar with this. We have assets, we have equity, expenses, income, and liabilities. And we're going to discuss each of these elements in more detail by looking at the definitions. So when we're looking at assets, okay, so there's an old definition which you mustn't be too concerned with, but the new definition, this is the one we are going to use here. So the asset definition, you guys should know that it is a present economic resource controlled by the entity as a result of past events. So now when you are asked to prove if something is an asset, you are going to use this definition, but you're going to go in detail. Okay, so let's have a look at this definition in more detail. And remember I said we're only looking at the new definition. Okay, we're not concerned with the old definition. It's just here so you can see the difference. But in your tests and exams, you must use this new definition. So let's have a look at the asset definition broken down. So an asset is an economic resource controlled by the entity as a result of past events. So when we are trying to determine if an asset is an economic resource, we need to see is there a right that has the potential to produce economic benefits? And a right is not always going to be like a physical object. It could just be access to something, okay, like access to an asset or access to occupy a property. And then what's important is that there must be a potential to produce economic benefits. The right must be able to produce benefits for the entity, okay? So there must be some kind of benefit. Usually it's a monetary benefit for the entity. So we need to look first, is there going to be a right that has the potential to produce economic benefits? Then we need to see, is that controlled by the entity? So when we are looking at control, we want to see can the entity direct the use of the economic resource? Can it obtain the benefits from the resource? And can it prevent others from directing the use of the resource? It could be a legal right. Okay, it doesn't always have to be, but it could be a legal right. And then past events, when was the past event? This must have occurred before the reporting date in order for us to record it. So we must see, was there an event that took place that resulted in this economic resource? Okay, so that is the asset definition breakdown. So when you are going to discuss or look at the various questions, use this to help you give full, complete answers. Okay. So let's have a look at an example together. We have Co-Pilot Pty Limited. They are a company that sells pencils. The company purchased land on which they built a shop where customers come to purchase pencils. The accountant of Co-Pilot Pty Limited is concerned that the new asset definition in the conceptual framework will result in certain items which are currently considered to be an asset to no longer meet the new definition and vice versa. He has provided you with the following list of assets that he would like a brief explanation as to whether they will still be an asset under the new definition. So we have inventory, which are pencils in this scenario. Then we have land and we have cash and savings account. You are required to use the new definition of assets and prove if the assets listed above meets the new definition of an asset. Let's first have a look at inventory. So we want to see, so the first part of the definition, so the whole definition is a present economic resource controlled by the entity as a result of a past event. So let's first have a look at a present economic resource. So what is the so we're looking here to see, does Copilot have a right and potential to produce economic benefits? So yes, Copilot, in terms of the inventory, so they are buying and selling pencils, Copilot has the right to sell pencils, which is their inventory. So Copilot has the right to sell the pencils, and when they sell the pencils, this has the potential to produce economic benefits through the inflow of cash or another economic resource when the pencils are sold. Okay, so we are happy there is a present economic resource there, which in other words, there's a right to sell the pencils and a potential to produce economic benefits. So we're happy that that part of the definition is met. Then we need to have a look at, is this controlled by the entity? Copilot has legal ownership of the pencils as they purchase the pencils. So yes, Copilot controls the pencils. And then we need to see what is the past event. So here, the past event is when Copilot purchased the pencils and gained control of them. Okay, so we are happy that all of the parts of the definition are met. So here, yes, the pencils do meet the definition of an asset. And obviously, Copilot will record this inventory in their financial statements provided the recognition criteria is met. But here we are just looking at the asset definition. So that is inventory. Let's have a look at land. So the definition is the same here. So we need to prove there is a present economic resource controlled by the entity as a result of past events. So here we are talking about land. So does Copilot have the rights to decide how to use this land? So yes, they do. Copilot has the right to decide how they are going to use this land. They decided to build a shop from which they are going to sell their pencils. So the benefit obtained is from an inflow of income to the business. So what this means is that Copilot has the right to decide how to use their land, and they are going to sell pencils by making a shop on this land. So the benefit is going to be obtained from an inflow of income to the business. Okay. So there is going to be benefits in the form of inflow of income from selling the pencils on this land. So we are happy that the land is a present economic resource. Copilot has a right to decide how to use this land, and this has the potential to produce economic benefits by selling the pencils. Then we need to look at controlled by the entity. So Copilot has legal ownership of the land as they purchase the land. So yes, Copilot can control this land and how they use it. Then we need to see what is the past event. So the past event is when Copilot purchased the land and gained control of the land. So yes, the past event would be the date that they purchased the land, and this resulted in them gaining control of the land. So yes, we are happy that the land meets the definition of an asset. We have proved there is a present economic resource that is controlled by the entity as a result of a past event. So we are happy that land meets the definition of an asset. And then once provided the recognition criteria is met, then yes, land will be recorded in the statement of financial position of Copilot. Let's have a look at the next one. So the next one is cash in a savings account. So the definition is the same here, okay? So cash in a savings account, the definition is a present economic resource controlled by the entity as a result of past events. So when we look at the first one, being a present economic resource, we need to prove, remember that there's a right, that Copilot has a right, and this has the potential to produce economic benefits. So Copilot here has the right to receive cash from the bank. So Copilot obviously put money in a savings account in the bank. So when we're looking at a right for the asset definition, we can say, yes, Copilot has the right to that money that the bank is holding. The benefits obtained, there are benefits that can be obtained from the use of the cash. So Copilot can use the cash in the savings account to purchase inventory and equipment, okay, and use these things to make a profit in the business. Then we need to see, does Copilot control the cash in the savings account? Yes, because Copilot would have a legal contract with the bank. When they set up the savings account and put money in there, there would have been a legal document that Copilot signed. So yes, Copilot can control the cash in the savings account through a legal contract that they would have with the bank as a result of past events. So what would the past event be here? So Copilot would have accepted the contract, which are like the terms and conditions with the bank, and they would have deposited the cash with the bank, okay? So that would be the past event, opening the savings account and putting money in the savings account. Yeah, so that would be the past events. So now we are happy that the cash in the savings account, it meets the definition of an asset. We have said that yes, there is a present economic resource. Copilot has the right to the cash in the savings account, and that can produce economic benefits. The cash in the savings account is controlled by Copilot, and the past event would be when Copilot opened the bank account and deposited the money in the bank account. So we are happy that cash in the savings account, it meets the definition of an asset, and therefore, provided the recognition criteria is met, this would be recorded as an asset in the statement of financial position. Okay, so you can have a look at your textbook and look at example 1 and 2 in this chapter in your own time. We are going to now look at the liability definition. So hopefully this is as familiar to you. So in the liability definition, again, we have an old definition and a new definition. So this new definition is the one we are going to use. So under the new definition, we have a present obligation of the entity to transfer an economic resource as a result of past events. So a present obligation is a duty or responsibility that an entity has no practical ability to avoid. Okay, so that is the definition we are going to use. And again, we're going to like break down the definition just to make sure that when you are answering a test or exam question, you must give a full answer, okay, to make sure you get the maximum amount of marks. And we're going to look at an example as well. So let's have a look at how we can break down this definition to make sure our answer is very complete. So when we look at a present obligation, we need to see, is there a present obligation? Okay, this is going to be a duty or responsibility that an entity has no practical ability to avoid. So there are going to be different types of obligations. There's going to be a legal obligation, a constructive obligation, a conditional obligation, which means there's no ability to avoid, okay, if it's a conditional obligation. So we'll be looking to see, does the company have an obligation? Is it a present obligation? Then we need to see, is there potential to require a transfer of economic resource? So, is the entity required to transfer an asset? It could be cash. So, if we have accounts payable and we're saying that's a liability, then the entity may have an obligation to transfer cash to settle that accounts payable. So, we need to see, is there potential to require a transfer of economic resource? And then the last one, what is the past event? So if the entity already obtained economic benefits, okay, so we're looking at a situation where the entity would have like taken a loan. What is the past event? So we're looking at that situation or thing that resulted in this entity getting the obligation. Okay, what did they do? Did they buy something on credit? And now they need to like transfer economic resources to settle that. So we're seeing what is the past event that led to this present obligation. Okay. So let's now have a look and use that definition to answer this question. So Traveling Pty Limited is a travel agency that rents office space from Sam Golding for 10,000 per month. The company has a December financial year end. As of 31 December 2020, Traveling Pty Limited still owes Sam Golding rent for the month of December. So using the definition of a liability, explain whether the rent owed for the month of December is a liability from Traveling Pty Limited's perspective. So here we have Traveling. They are a travel agency and they have rented office space. They have a December financial year end. They have used the office space, and as at 31 December, they still owe Sam rent for the month of December. Okay, so we want to know, like, is this a liability? Because then it can be recorded in the Traveling Pty Limited's books as a liability. But first, let's have a look at the definition. So remember, the definition of a liability is a present obligation, and this obligation involves the transferring of an economic resource as a result of past events. Okay, so let's have a look at the present obligation. Okay, is there a duty? Like, we want to make sure there's no practical ability to avoid the obligation. So Traveling has a duty to pay Sam Golding the monthly rental, okay? Can Traveling avoid paying? No, they can't. Traveling will have a rental agreement with Sam, which is legally enforceable. So we are happy that Traveling has a present obligation. They have a duty to pay Sam Golding the monthly rental. And as there's a rental agreement which is legally enforceable, there's no practical way that Traveling can avoid paying the rent. Okay, so we are happy that the first part of the definition is met. Then we have the second part. Obligation involves the transferring of an economic resource. Traveling must pay Sam Golding 10,000 in cash. So this is an obligation that they have. And so Traveling has an obligation, and this will result in a transfer of an economic resource of 10,000 Rand in cash as a result of past events. So Traveling Pty Limited used, we're looking for a past event here. So as Traveling used the office space during December to run their business, they have obtained a benefit in December. Okay, so that would have been the past event. And now they have to transfer an economic resource as a result of this past event. So Traveling has to now pay 10,000 Rand for the rent. They occupied the office space to run their business and obtained a benefit, and now they have to transfer the 10,000 Rand, which is an economic resource. So yes, we are happy that Traveling has a liability. The definition is met. And then provided the recognition criteria is met, this liability would be recorded in the financial statements of Traveling Pty Limited. Okay, so that is the liability definition. You can have a look at example 4 in your textbook in your own time if you want an extra example. Okay, so Karabo is asking, is it a legal obligation? So yes, I would say when you have a rental agreement, that is legally enforceable. So they did say that here. They said traveling has a rental agreement, and this is legally enforceable. So if they tell you in the scenario there's a agreement or a contract, then that is usually a legal obligation, and I would mention that in the answer because that's usually for a mark. Okay, so let's have a look at equity now. So equity, this is the residual, the remaining interest in the assets of an entity after deducting all its liabilities. So equity equals assets minus liabilities. Assets equals liabilities plus equity. Okay, so this is just framing the accounting equation. You can move all of these around to get different types of equations. But if you think about your statement of financial position, on the top half you have the assets, and that total should equal the total of your liabilities and your equity. So let's have a look now at an example. Okay, using the accounting equation here, we're going to look at an example. WoodHub is a company that sells desks and chairs. On the 2nd of January 2020, WoodHub purchased property for 1.2 million. 1 million relates to the building and 200,000 relates to the land. The transactions were funded through equity. So we want to use the accounting equation to show the effect of the above transaction. So let's have a look at the first one. So on the 2nd of January, WoodHub purchased property for 1.2 million. 1 million relates to the building, 200,000 relates to the land. So how are we going to show this? So remember we said that the 1.2 million, we have land and we have buildings. Okay, this is going to increase our assets. And then, so we are going to debit our assets with 1.2 million. They have shown the buildings and the land separately. And then we are going to credit equity with 1.2 million. Also, again, showing the 200,000 and the 1 million separate. Okay, so that is just using the accounting equation to record that transaction. Then on the 10th of January, Would have purchased a car for 20,000. Would have agreed to pay the 20,000 on 28 Feb 2020. So they've bought a car on credit, essentially. So how do we record this? So we are going to record the asset. We are debiting the asset account. We have an increase in assets with 20,000. We have just bought a vehicle. And because we have bought on credit, we are going to credit liabilities. So this would be your accounts payable or your creditors account. So we are debiting assets 20,000. We are crediting liabilities with 20,000. So equity here, there's no direct effect. But obviously when you look, so once we total these transactions, you'll see the total of these. The accounting equation is in balance. On the asset side, we have 1,220,000, and this can be broken down into 20,000 for liabilities and 1.2 million for equity. But you'll see that our debits equals our credits here. This is in balance. So we're happy that the transactions were recorded correctly because the accounting equation is in balance here. Okay, so that is just a simple example for equity. But let's have a look at income now. So just like we had an old definition and a new definition for assets and liabilities, it's the same with income. So we have provided the old definition, but we are going to focus here on the new definition. So we are going to say that the new definition is the one we are going to use. And it says that income is an increase in assets or a decrease in liabilities that results in an increase in equity, other than those relating to contributions from holders of equity claims. So this is the new definition that we are going to use. So let's have a look at an example where we use this definition. So remember we said it is an increase in assets or a decrease in liabilities that results in an increase in equity other than those relating to contributions from holders of equity claims. So let's have a look at our example. So traveling is a travel agency that rents office space from Sam Golding. On the 1st of November, Traveling paid Sam Golding rent for the month of November. Sam Golding's reporting period ends on 31 December 2020. Using the definition of income, explain whether the rent received by Sam Golding on 1 November 2020 satisfies the definition of income. So here we are reporting from Sam Golding's perspective. They have received rents for the month of November of 10,000 Rand. And we want to know, does this meet the definition of income? So let's have a look at the definition. So remember we said the definition starts with there must be an increase in assets or decrease in liabilities, okay? So when Sam receives the rental income in their bank account, this is going to result in an increase in assets. So rental income from the letting of the office space is going to increase Sam Golding's bank account by 10,000 Rand. So remember, bank is an asset. So yes, we are happy that there is an increase in the assets of 10,000 Rand. So we met the first requirement. So remember, the next requirement is this results in an increase in equity. So if you think back to the accounting equation, when we have an increase in assets, this is going to result in an increase in equity, okay? So the Sam's bank account received 10,000 Rand, that increased the assets. As a result of the assets increasing, this resulted in an increase in equity. So we're happy that the amount received increases equity as the assets increased. And then we need to just look at the last requirements, other than those relating to contributions from holders of equity. So we need to make sure that this doesn't relate to a contribution from holders of equity. So this would be a holder of equity would be like a shareholder. So we are happy that this requirement is met. So the 10,000 Rand is received from a tenant and not a holder of equity. Therefore, there will be no contribution from holders of equity. So we are happy that this last requirement is met. The money is being received from a tenant. It is not being received from a holder of equity. Therefore, the full definition of income is met. We have proved there was an increase in assets, which resulted in an increase in equity, and we were happy that it didn't relate to a contribution from a holder of equity. So the income definition is met, and Sam Golding will record the 10,000 Rand as an income in their books. Okay, so you guys can have a look at an additional example in your textbook later. So far we've done the asset definition, the liability definition, and the income definition. So let's go to now the expense definition. Hopefully this is should be familiar to you because I believe you guys did the conceptual framework in second year. So let's now have a look at the expense definition. So remember, we have the old definition and the new definition, and we're going to focus on the new definition. So under the new definition, we have decreases in assets or increases in liabilities that result in a decrease in equity, other than those relating to distributions to holders of equity claims. So this is kind of the opposite of the income definition. There, under the income definition, we wanted an increase in assets or a decrease in liabilities. So see here, the income definition wanted an increase in assets or decrease in liabilities. Under the expense definition, it's kind of the opposite. So here, in order for us to prove an expense, it must be a decrease in assets or an increase in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. So that is the definition we're going to use for an expense. Let's see if we have an example to do. Ecoplastics is a company that sells environmentally friendly plastic grocery bags. The company has a bank account which they transact from. The bank charges for the month of September 2020 was 500 Rand. Ecoplastics has an October 2020 financial year end. Using the definition of expenses, explain whether the bank charges in the amount of 500 Rand satisfies the definition of an expense. So here we need to go through our expense definition. So remember we said we need to prove that there is a decrease in assets or increases in liabilities that result in a decrease in equity other than those relating to distributions to holders of equity claims. So let's start at the top. Is there a decrease in assets? Okay. Is there a decrease in assets or an increase in liabilities? Okay, so it's either of them. Okay, so there's no decrease in assets. However, there is an increase in liabilities. So the bank charges increases Ecoplastics liabilities. So we are happy that there's an increase in liabilities. And as a result of there being an increase in liabilities, this is going to decrease equity. So equity is going to decrease. Then we need to make sure, other than those relating to distributions to holders of equity claims. So we need to make sure that the bank charges does not involve a holder of an equity claim. So remember, an equity claim is like, it would be seen as like a dividend or something we are giving a shareholder. So the bank charges involves the bank and not a holder of an equity claim. Therefore, it is not a distribution to a holder of equity. So we are happy that the definition is met. We proved that there was an increase in liabilities, okay? Remember, it was a decrease in assets or an increase in liabilities. So we were happy that there was an increase in liabilities that resulted in a decrease in equity, and it did not relate to a distribution to a holder of an equity claim. So the bank charges therefore meet the definition of an expense. Okay. So therefore, they would be recorded as an expense in the financial statements. So far we have looked at the various definitions of the elements. Now we need to look at the recognition, okay? So what is the recognition and derecognition? So when we recognize something, this is the process of capturing an item in the financial statements. So an item must meet the definition of an element, okay? So when we recognize something, it is being depicted in both words and amount. So the amount is included in one or more totals in the financial statements. Okay, when we recognize something, obviously it must meet the definition of an element. And when we recognize something, we are displaying it using like a monetary value. Okay. So, and this monetary value will then be included in the total in the financial statements. So let's have a look at the recognition criteria. So we are going to look at the new recognition criteria. So here we have assets and liabilities, and any resulting income, expenses, or changes in equity must only be recognized if the user would find this information useful. We only recognize the elements if it means we are providing information that is relevant and a faithful representation. Okay, so that is our recognition criteria. So once we have met the definition of an element, we need to then assess the recognition criteria. So we are going to ask ourselves, is this element we have recognized, is it information that a user would find useful? And we are only going to recognize the element if it means we are providing information that is relevant and a faithful representation. So when we look at the two words relevance and faithful representation, what does it actually mean? So when we look at relevance, we want to make sure that so it is relevant information, okay? It is certain. So relevance is going to be affected by existence uncertainty and outcome uncertainty, okay? And then faithful presentation, this is only affected by measurement uncertainty. So you'll see that sometimes an element can be recognized based on an estimate. So estimations are a normal part of accounting. Estimates does not mean that the information presented is not useful. So if there is a provision for rehabilitating the land after a mine is built, it's impossible to know exactly rand for rand what it's going to cost in 5 years' time to rehabilitate the land, but we can make an estimate based on a current quote. We could obtain a current quote and then we'll increase it for inflation. So that would be an estimate, okay? So if something like faithful presentation, if it's the best estimate, then that is good enough. Okay, as long as the estimate is as accurate as possible based on the information, it is okay. So when we look at the recognition criteria, we need to make sure that the information is relevant and it is a faithful presentation. Then we need to look at derecognition. So derecognition is the removal of all or parts of a recognized asset or liability from the company's statement of financial position. So to derecognize any asset or liability, so we are going to derecognize any asset or liability that fails to meet the relevant definition. Okay, so if it can't meet the relevant definition, then we cannot record it, and it needs to be derecognized if it was previously recorded. So we're going to derecognize any asset or liability transferred, consumed, collected, fulfilled, or expired. So you'll see derecognition when we look at property, plant, and equipment. So there we will derecognize some assets. You may have even seen it in second year, but if not, we'll have a look at how to derecognize some items of PPE. So just remember that it's when the asset or liability definition is not met, okay? Then we cannot record that item or continue to record it in our financial statements. Maybe previously it was met, but now something happened to the asset or liability which resulted in the definition not being met. Therefore, we have to derecognize it. So when we have derecognition of an asset, derecognition normally occurs when the entity has lost control of all or part of the previously recognized assets. And then we have derecognition of a liability. Derecognition will happen when the entity no longer has a present obligation for all or part of the recognized liability. Okay, so we can derecognize an asset or a liability But obviously we'll need to go through like the definition and make sure that that if it doesn't meet the definition, then we need to derecognize it. Okay, so now we need to look at measurement. So we've looked at the elements of financial statements. So when these element definitions are met, we need to then quantify these in the financial statements. So measure means to quantify. We need to provide like a rand value. So we need to provide a rand value and measure all of the elements in the financial statements. So when we look at measurement, there are two main categories. So we have historical cost and we have current value. So these are the main categories. So historical cost would be like the price you paid when you bought that asset. And then current value can be broken down into fair value, value in use, and current cost. So think about your PPE. Once you buy an asset in a year or two, you may need to revalue that asset to fair value. Okay. So here our two main bases are historical cost and current value. And then under current value, we need to look at the fair value, the value in use, and the current cost. So let's have a look in more detail at the historical cost. So this is the value of the costs incurred in acquiring or creating the asset, or the consideration paid to acquire or create the asset, plus the transaction costs. So the historical cost of an asset, this is going to be the minimum economic benefits that the entity expects to recover, okay? And it includes transaction costs and takes into account the accumulated depreciation, amortization, and any like accumulated impairments. Then we have historical cost of a liability. The maximum economic benefit the entity expects to transfer out in order to settle a liability. Okay. So this is historical cost. So this, you see it a lot in property, plant, and equipment when you are acquiring or creating an asset. So let's now have a look at other measures. So we said that one of the main categories is historical cost. Then we have other values which are like current values. This measure provides monetary information about assets, liabilities, and related income and expenses using information updated to reflect conditions at the measurement date. So this would be like buying property at the historical cost, at the price you paid, and then maybe 2 years down the line, you need to revalue this asset. So then you would look at things like fair value. So the current value can be like based on the fair value, it can be based on the value in use, or it could be based on the current cost. So you'll see the different measurement bases when we look at property, plant, and equipment. So let's have a look at, just to refresh ourselves, what is the fair value? So the fair value, this is the price that would be received to sell an asset or paid to transfer a liability at the measurement date. So examples where we use fair value are investment property, property, plant, and equipment, financial assets, and financial liabilities. Then we have value in use. Here, this is the present value of the cash flows or economic benefits that the entity expects to derive from the use of an asset and from its disposal. Then we have a value in use of a liability. This is the present value of cash or other economic benefits that the entity expects to be obliged to transfer as it fulfills its liabilities. Then we have a current cost. This is cost of an equivalent asset at measurement date, and this takes into account the consideration paid and the transaction cost. Then we have the current cost of a liability. This is the consideration that would be received or equivalent liability at measurement date. Okay, so these are all, if you want to know what the explanations are for each of these, this provides a useful summary. So factors to consider for measurement. The measurement must provide relevant information and it must be a faithful representation of the substance of the transaction. Okay. In addition, we should strive to achieve that is comparable, verifiable, and timely. Okay, so when we measure something, we must make sure it is comparable from one year to the next. Ideally, we'd like to use the same accounting policy unless there's a specific reason. The measurement should be verifiable, like how did we determine the fair value? Was there an independent valuer? And then when we look at measurement, we also want it to be timely, okay? Because remember, we need to prepare the financial statements and then release the information in time so that users can, like make decisions. Then when we look at measurement, we also need to consider initial and subsequent measurements. So remember when we look at property, plants, and equipment, we have initial measurements when we first acquire the property, plants, and equipment, and then we have subsequent measurements. So subsequent measurement would be like depreciation and any impairment losses, or if we need to revalue the assets. So it's important to think about like how initial and subsequent measurements is different. Okay. So then let's have a look at presentation and disclosure. So here we have classification. So classification of assets, liabilities, equity, income, or expenses. So when we classify these items, we are going to classify similar items together, okay? So you'll see in the statements of financial position, we put all the non-current assets together and all the current assets together. And each element has its own place in the financial statements. So sometimes it's appropriate to separate an asset or liability into its components. Okay, so I've said this already. We are going to group our current assets together. That is assets that are going to be realized in 12 months or less. And then our non-current assets will be grouped together. These would be things like property, plants, and equipment, or anything that is not going to be realized in the short term. And then we will do the same with our liabilities. We'll have our current liabilities and our non-current liabilities. Then we need to look at offsetting and aggregation. This is also important for presentation and disclosure. So offsetting occurs when an entity recognizes and measures both assets and liabilities as separate units of account, but it groups them in a single net amount in the statement of financial position. Okay, so sometimes we will offset something, and then aggregation. Aggregation occurs when we are adding elements together that have shared characteristics and that are included in the same classification. So we also need to consider these when we are presenting and disclosing our elements. Okay, so that is the end of it, guys. Hopefully it was revision from second year. You can see a summary in your Gripping GARP textbook on page 72. So that is the end of it. And remember, what are your tasks going forward? You need to practice the examples in the textbook. You need to do the practical question and the tutorial questions, which are in Moodle. And if you need help, you can consult. Okay. So let's just have a look at the chat. Do we use the same recognition criteria for all elements? Yes, we do. And then do you guys have any questions relating to today's lecture or to the timetable?